If you drive for Uber, Lyft, or DoorDash, there's one tax mistake that can quietly cost you thousands of dollars every single year. And most drivers don't even know they're making it. Let's break it down. Here's the mistake: not tracking your miles, or only deducting the miles the app shows you. For a rideshare or delivery driver, your mileage is almost always your single biggest tax deduction. Miss it, and you overpay the IRS by a lot. Why does this cost so much? Because of the standard mileage rate. For 2026, the IRS lets you deduct 72.5 cents for every business mile you drive, up from 70 cents in 2025. Let's put real numbers on it. Say you drive 20,000 business miles in a year. Very normal for a full-time driver. 20,000 miles times 72.5 cents is a $14,500 deduction. And here's why that matters. That deduction lowers both your income tax and your 15.3% self-employment tax. Depending on your bracket, a $14,500 deduction can put roughly $4,000 to $5,000 back in your pocket. That's the mistake, leaving that money on the table. So which miles actually count? More than most drivers think. The miles with a passenger in the car, the miles driving to pick someone up after you accept a ride, and the miles driving to a busy area to wait for requests. All generally deductible business miles. But not every mile counts. Your commute from home to the first area where you start driving doesn't count. Personal errands don't count. And you can't deduct miles when the app is off and you're not working. And here's where it all lands. This is Schedule C, the form self-employed drivers file with their return. Your total mileage deduction goes right here on line 9, car and truck expenses. So how do you fix it? Keep a mileage log. The IRS can throw out your entire deduction if you can't back it up. Guessing at tax time doesn't count. A free mileage tracking app that runs in the background is the easiest fix. Track every business mile all year long. One more thing. You can take the standard mileage rate or your actual car expenses, gas, repairs, depreciation, but not both for the same vehicle. For most drivers, the standard mileage rate is simpler and often bigger. Run it both ways and take whichever is larger. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience. So the rules you're hearing are checked against the IRS sources. Always educational, never advice for your specific situation. So the bottom line? If you drive for a living, your miles are your money. Track every business mile, use the 72.5 cent rate for 2026, keep a real log, and claim it on Schedule C. Don't hand the IRS an extra few $1,000s you never owed. This is general education, not tax advice, so check with a pro. Subscribe to the Tax Breakdown for tax rules in plain English.